the reason why maybe they delay getting a financial advisor is because it's so tough to like find a good, reputable one.
Well, everybody, welcome back to another episode of the KarWell Chronicles. Got it right.
Mm-hmm.
Honestly, we're on a little bit of a family and friend journey on this podcast
I was
right
thinking
now.
about that. Taylor was talking about that when I told her who was on the episode. So.
I love that. I love that. I think it's very reflective of how we want to go more lifestyle brand. So look at us go kind of unintentionally.
Yeah, there we go.
Well, we have a very special guest on our podcast today. This is my brother.
If you're watching, you can very clearly tell.
We don't look anything alike.
Yeah. And to give you guys a little bit of background on Caleb from, I guess, my perspective, and maybe you have some input here as well. But I always tell people when I talk about my brother, I say that he was born at 50 years old. Like,
yeah, he is the older brother.
Yeah,
actually.
He is my younger brother, but he is the older brother. And I just think that even when you were 12, you were mentally 50. Like, just so put together, so responsible, like always interested in things that were adultish.
I got to learn from my rebellious old sister what not to do. Older sister.
You paid very close attention. Good job.
Yes. I am the black sheep of the family, and Caleb is calm and steady.
Yes, very much so.
So you are getting to meet my opposite today. Yeah. With that being said, I think that one thing that Caleb and I do really relate on is that we really like talking about money. And so that's a very common topic in our family. My dad likes talking about money as well. And so I think it's interesting that both of us are in fields that very much have to do with investing, but kind of on the opposite end of the spectrum.
Yeah.
And so we have a bunch of questions for you today. But before we dive in, for our listeners who have no context on who you are you? What do you do for your career currently? Like, kind of give us a background on you from your perspective.
Yeah, definitely. So I'm a financial advisor, which I feel like can be very different in different contexts, but mostly I work with just retail clients. So like your everyday retiree, someone who's, just starting out working, someone who's getting close to retirement, people who've been in retirement for 20 years, work with some businesses and help like set up 401ks and things like that. But it's mostly just individual households, which is one of my favorite parts of it, where you just really get to know your, 150, 200 families that you work with and get to go really deep with them. Mm-hmm. And we like to say, we kind of focus on holistic or comprehensive financial planning. So it's not just, the investment side of things, which most people think of when they think about their financial advisor, but it's also going deep on the tax strategizing and making sure like your legal life is in order and insurance and all that kind of stuff too. So.
Yeah. And it's amazing too. Like when I was thinking of these questions, I was like, wow, it's amazing how little I know about what you do. Like, I'm like, wow, these are questions that I don't know the answer to coming into it.
Yeah. And it is interesting that you like go past just like the finances. Cause I've had one experience with another financial advisor. It was horrible. We never called him back.
Same.
But, yeah, it was a really bad one. But he was asking like a lot of those questions too, and I was like, "That's none of your business." But then it was like, actually, maybe it is.
Yeah, I know that is unique because like even in like the first meeting that I have with clients, a lot of times on the intake sheet that I have, one of the things I talk about is like health, and I'm like, all right, so are you generally healthy? Do you smoke? Do you use tobacco? Are your parents still living? Did they have dementia? Did they have Alzheimer's? And I've now learned to kind of preface that question first to be like, hey, I'm going to ask a couple health questions. Here's why.
Yeah.
Because a lot of people will be like, why are we talking about that in like a finance meeting? And it's like, well, the cost of a nursing home eventually can be really expensive. If your parents have dementia or Alzheimer's, that might be an indicator we need to at least be aware of that. Mm-hmm. So, and just knowing how long somebody's going to live in retirement. Like, do I need to plan to, have you have an income stream through 75, or are you going to live till 100? Mm-hmm. And that's a massive difference. So it plays a big role.
Yeah, that sounds like a way better version of asking those questions than the guy who asked me. The guy who asked me had previously spoken with Dale, and he was like, well, do you know what happened to Dale in college? And I was like, do I know what happened? I was there. And he was like, well, if that happened to you, like imagine if she hadn't made it and what her family would have been left with. And I was like, dude, That is not the way to like get me to think about my health and my future.
Aggressive sales strategy.
I know, and I was like, I'm not calling you back. That was so aggressive.
Also, maybe some client confidentiality breaches there too. So, like, do you know about this? My other clients, like, very serious.
And he did not know that we like knew each other that well. Like, he didn't know that me and Dale were best friends. And so him telling me that, I was like, dude. No. So yeah, way better approach to that question you have than he did.
Yeah. Yikes. No, thank you. Well, how did you end up in this position? Because obviously I have context that you didn't start out being like, I'm going to school to be a financial advisor. So talk us through how you ended up here.
Yeah. I've always been interested in finance. I mean, since we were young, getting $7 a week for chores for like cleaning the horses' stalls and everything. I mean, it was just socking money away all the time.
Sarah was blowing hers.
yeah, she was. Yep. I was loaning money to Sarah at a young age.
At an interest rate.
Yeah,
the
exactly.
OG bank.
It wasn't free. But I mean, yeah, just always been interested in finance. Going to college, wanted to do something in finance, but I'd say like two of the main like career paths that some of the, maybe higher performing people in like my class were going towards would be like consulting and investment banking. And coming from Grant, I had never heard of either of those two things. but
No
all
kidding.
these kids like, going to school coming from, Miami and Chicago and California, they were like, yeah, like this is where to go. And I really liked investment banking, but everyone said you're going to be working 80 hours a week, like coming out of school. And I just was really not willing to do that. And so consulting was kind of the other path, which is still, somewhat finance oriented. But even in college, I took all of the finance classes, like the upper level finance classes that you would normally take if you're doing investment banking, but still just went and did consulting and really liked it. Had like an internship and got invited back for a full-time role. But the year that I graduated, they ended up having a hiring freeze. Mm-hmm. And so they were like, yeah, we're not bringing anybody on right now. Nobody's really bringing anybody on right now. But as soon as we start bringing people on, like you're top of the list, we'll have you start in Chicago. And then my father-in-law, so Sarah's dad, Sarah, my wife.
Let's specify.
Right, yeah. Always confusing. But her dad's a financial advisor. And so that summer he was like, well, hey, there's this test called the Series 65 that you could take, just in case the consulting thing, if that hiring freeze just stayed out there, you could look at something in finance here. So studied for a few weeks, took that test and passed it. And then
casually.
After that. What?
Casually.
Yeah, I know. So,
everyone was like, he's going to have to take that a few times. And I'm like, okay.
No, you don't know Caleb.
Yeah.
He's been taking the ACT since he was like 5.
Literally.
Another contentious point of growing up was the comparing ACT scores.
Literally.
But yeah, so yeah, took that. And then basically right after I passed it, the firm in Chicago, the consulting firm was like, hey, we got a spot, we can have you start soon. So I was like, all right, I guess I'll just never use that Series 65. But went to Chicago, did the consulting thing. And then Todd knew of an advisor in Fort Wayne who was, in the middle of purchasing another book of business. This advisor needed, probably some help, but needed another advisor on board to help service those clients. Mm-hmm. And so he was like, you need to talk to her. And so ended up doing an interview with her. It was just like a great fit. I went in, kind of sat through a few meetings that she had with clients, and they were just all just salt of the earth, like wonderful clients. All of them are just like, hey, I need to make sure I'm like budgeting in, tithe to my financial plan. And like, I need money for like missions trips that we're doing with our church every single year. So I was like, this is like a really cool client base, and felt very similar to, just like the Midwest kind of values that we grew up with, and different than what I'd experienced in Chicago for like the year before. So just really felt called to go there. And so we moved to Fort Wayne and have been working there ever since. And it just feels like such a good fit. Like these are definitely the clients that I want to serve, for my career, which is really exciting.
Yeah. Yeah, that makes sense. I mean, I think I was a little surprised when you made the move, because you were working in the Sears Tower or the Willis Tower or whatever in Chicago. And like, I don't know, it just made sense. Mm-hmm. Like in my head, watching you grow up and imagining where you'd end up, like that in my head fit the bill.
Right.
And so then when you decided so quickly to like leave and go to a smaller city for a smaller company and like made that decision, I was like, for real?
Yeah.
You know, like why? So I think that now hearing why you decided to choose that makes a lot of sense, but I just didn't see that coming at all at that point in time.
Right. Yeah. Consulting, I feel like, is kind of a flashier lifestyle. You know, you're like living downtown in Chicago, working in the Willis Tower. You know, you're like rack up the Marriott points and you're traveling and you get all these perks and stuff. But I think long term, we always knew that we weren't going to live in Chicago forever. Like we didn't want to raise a family in Chicago. We still anticipated being there a lot longer than what we were, but it's like when the opportunity pops up, you feel like you got to jump on it. And, you know, the prospect of just being able to grow a business like that over time is really exciting, because it just seems like in most careers, I mean, almost every career in the world, the farther you get, it turns into sales. And so like with consulting, you know, you start out, you're an analyst, you're, you know, building slide decks and you're, you know, helping with the client and stuff like that. And your client's, you know, a big business at this point, you know, like the C-suite, they're asking you to solve some problem. And so as an analyst, it's exciting. You get to solve those problems, you get to do those things. But the further you move up, if you're eventually a partner, you're needing to sell projects. And so you're needing to have these contacts on, you know, C-suite boards of these different big companies and convince them to hire your team for $200,000 a month or whatever it is. And to me, that volume of sales is almost scary, because it's like when you're a partner, you need to get 2 sales a year, you know, sell 2 like 6-month projects or something like that. And you've kind of met your commission. You've done great for the year. On the other end of the spectrum is like maybe what Ethan has, you know, done with insurance. It's like you have 1,000 clients and you're servicing all of those. And that's kind of equally as scary. It's like you're running yourself into the ground doing a lot of that. Financial advising seems like there's a good middle ground where, you know, you get your 200 families, you keep them, you know, happy, you service the heck out of them, like you do great for them, and you can keep them for, you know, 30, 40 years. And you just go really deep with those clients. So that it seems like a really good happy medium where everyone can benefit. You still get to know the clients really well, but there's also not that pressure of like, hey, I need to get 2 giant clients a year. If one of them falls through, my commission is cut in half. You know?
You're looking for the whales like we were talking about yesterday. Yeah, that's so interesting to think about, because I feel like the podcast that I just did with Ethan, we talked about that exact spectrum of how he went from selling a free product to as many people as possible to now we're working with 2 or 3 clients a year, and that's it, right? We're looking for that whale. And so, it's a different pressure on both ends, but typically I think the conversation is to stay away from the middle, right? Like don't get caught in this like mid-grade product. But in your case scenario, you're like, no, I think that this is the safest zone, you know, the zone that makes most sense.
If you find the niche and you end up, you're good at it and you can service them well and keep the clients, keep that retention, then it can be a really good fit.
Yeah. Well, and I think too, you say you don't want to be in sales, right? Or like you were kind of avoiding that, but like growing up, we watched you be salesman of the year in so many different ways. Like to give the listeners a little bit of context, one of my favorite stories, I think I have 2 really that exemplify this well, but one of which was when you went to basketball camp and mom sent you with like, I don't know, a whole pack of Gatorade.
Oh, yeah.
And you came home with money because you sold, you didn't drink the Gatorade, you sold it.
Right, yeah.
Or when you were at the, like the school movie and you had like a giant bucket of popcorn and you ate the first one and you got a free refill, so you sold the refill.
Oh yeah, I forgot about that one. Yeah.
Do we not talk about the phone plan presentation that he sold to your parents?
That's true. Oh my gosh, yeah.
I ended up using that to get a phone from my parents.
I was like 10 years old, I think.
Yeah, you guys wanted like the EV phones or what, Evo phones or whatever?
Yeah.
And you like put together a whole presentation, sold it to your parents.
I know, man. I'm trying to remember how, like, what was the sticking point for that, how I ended up getting them. But I think Sprint had some deal or whatever, you know, when you
like broke it down for him really well. I remember.
Yeah, we'd go to the mall and Sarah would be in Abercrombie and I'm at the Sprint store talking to the salesman guy, like, all right, give me your information. They're not going to buy it from you, but they'll buy it from me. So coach me up here.
So true. Seriously. That's what I'm saying. You were like 7 in a suit, ready to like carry around a briefcase and sell people stuff. Like it was just one of those things where I was like, where is this kid going? What are we doing here?
Can you break down really quickly, because I think I mistake financial advisor and investment banker a lot for like the same thing. investment bankers like the people working in the stock market on Wall Street. Am I correct in that?
I
And
literally
financial
don't know.
advisor is a little bit different than that. Like you dive a little deeper as far as like life insurance, full life planning, not just like stock market investments. Is that correct?
Right. I think maybe like, are you kind of thinking about the people on the floor of like the stock exchange?
Yes.
Yeah. So I mean, that's like a very unique group of people. A lot of times the investment bankers are folks that will work for like Goldman Sachs or something, help companies go public, let's say.
Okay.
Help them IPO and things like that, or raise capital. A financial advisor like what I do, there can be a lot of flavors of that. So like the person you talked to, it sounds like they were probably trying to sell life insurance.
Yes.
And they might mostly do life insurance. I can sell life insurance, and I do for a lot of my clients, but mostly I manage their investments. And so it'll be someone who has a 401k, they're about to retire, and they roll their 401k to me to manage. I have like discretionary trading authority over the account, so can decide what they are actually invested in. We'll actively manage the account, so we'll trade it, so anytime we think there's a need to trade in the account, if we see things change in the market or something like that. And typically how investment advisors like that make money is like by they're fee based. So the assets under management that we manage, we take a certain percentage of that every single year, and then that covers everything that we do. So all the trading, meeting with the clients, helping with withdrawals, making recommendations, helping with just their personal finances, all of that is kind of wrapped up in that assets under management fee. Whereas a lot of times the life insurance folks, if they only do life insurance, a lot of times that's just commission based. So like you sell a policy and you get a certain percentage of like the first year's premium that the person pays. So I mean, a lot of times the life insurance is much more, hunting, where every single year you're needing to get new clients, new commission, things like that. The assets under management, basis is more of like farming. You just get your clients, you have the assets that you manage, you're attempting to grow it for the clients at the same time, like you get a certain percentage fee of that every single year. And so there's no like big upfront fee or anything like that the clients pay. So they're, free to move to somebody else if they're unhappy that next year. So it's very much about keeping the clients happy, doing really well for them.
That makes sense.
Mm-hmm.
For clients, like referring to real estate specifically, do you ever, or like, I guess it might be too wide of a base of knowledge for you to like really have to focus in on, but like if somebody is a big real estate investor and they're looking to like sell their portfolio and kind of move it somewhere else, is that something that you at least advise them on, or is that like too much to know outside of what your like baseline is?
No, that's well within the wheelhouse. And I think the goal, at least with our firm, is to try to be as comprehensive as possible. So we don't want to just silo and say we only work on the investments or like we only do taxes or whatever it is. It's like if somebody has any sort of finance question, come to us with it. And if we don't know the answer, we'll figure it out and let you know or connect you with the right people. So like I have plenty of clients who have made the bulk of their net worth through real estate. And so now we just have conversations about, is this something we want to pass down to the kids? Is this something we want to start unwinding right now? If you keep it like your entire life, a nice benefit is that the properties get a stepped up cost basis at death. And so there might be a big gain on the property. But if you pass it down at death, like the kids don't owe any taxes on it. But if the kids don't want the property or don't want to manage it, are they going to be forced to now sell 15 properties like to try to close out your estate? And are they going to take a less than optimal, dollar value for those estates? So maybe we do sell the properties ahead of time and pay the taxes. So, I mean, those are a lot of those conversations that we have. Or like, what's the cash flow? What's the internal rate of return that this property is generating you right now? Like, are you taking a subpar return, just because you're trying to avoid the taxes on it? And so we compare that to investments and like, how much time are you spending on this property? A investment in the stock market is pretty low maintenance most of the time. So
Properties are not.
yeah, exactly.
What do you mean?
Right. Yeah. Investing in a stock is like being the fun uncle. Owning the real estate is like being the parent. Like you are managing that every single day. You're spending a lot of time there. If I own like a share of an S&P 500 ETF, I never have to really worry about it. I'm just, it can go up and down, of course, just like any other investment. But I'm not having to put a lot of blood, sweat, and tears into it too.
Yeah.
Yeah, that's so
One
fair.
of those points you made is probably something nobody thinks about, because I feel like when people are buying real estate, they're like, generational wealth and my kids are going to want this. But you're like, what if they don't? And then they have
Right.
all this work to actually sell the properties for you.
Yeah, it's most of the time not a passive investment. And if it is a passive investment, you're probably not getting the return maybe that you think you are. Like one of my old bosses in Chicago, he's like the largest landowner in Needham, Massachusetts, like right outside of Boston. So he has 70 acres there, like not too far from the city, just a massive estate. And, it's 10x since he's bought it. And he always said,
Nice.
you
Good for
know,
him.
yeah, it looks like it's done good. He's like, it's been an okay investment because there's so much like carrying costs for the properties. At the same time, most of it was not like rented out either. So, I mean, it's purely appreciation. You're not getting any sort of rental income from it. But even then, it's done well, but he's paid just a ridiculous amount in property taxes over the course of that entire time.
Yeah.
And so that's been relatively passive for him. But it's like if it would have been rented out, it would have been, a better return, but a lot more of a headache too. So, I mean, you're always kind of weighing those things. There's a big cost to your time. And of course we all know that.
Well, it's nice to think that big plots of land are good money makers, but the more I look into it, the less buildable they are anyways, and you're just paying property taxes on not buildable land.
Yeah.
Right.
Yeah, that kills me. Every time I see a property with land, I'll dig into it, and it's like 75% of it is swamp or not buildable.
High water
or-
table, and you can't put a septic on it.
Yeah. I'm like,
Yeah.
okay, well, this is worthless, but you still are, the price tag reflects it. So.
Right. I know I just sent you a property this morning too that I was looking at, like a lake house, and it was Michigan or Indiana, and like everything looks great. Price looked good. House looks beautiful right on the lake. Get to the very end of the listing, and it's like, front yard is located in like a flood area, but it's not on the house. And I'm like, okay, I need a little bit more context here. Like what?
So people are gonna just walk through water to get to the house. Got it.
Yeah, perfect.
Yeah.
Here's your
Good
waiters to get to the
experience.
Airbnb.
Right.
Kill me. So one question I have for you, because obviously like Emily's coming from a perspective of dealing with one financial advisor, hating it. I have obviously hired a financial advisor and hated it as well, and immediately took my money back out and was like, I'm putting it in real estate. Can you tell people who are listening to this, like, one, what's the advantage of having a financial advisor and how to find a good one?
Yeah, that's a good question. I mean, the advantage I think is different for everyone. Everyone has like different needs with their finances. And so some people need help even knowing how much to contribute to their retirement accounts. Some people need help knowing when they can retire, how much money they need to retire, or what to actually invest in. And so there's a ton of different things that we talk about when we do a financial plan for somebody. A lot of times we're going through taxes, we're going through their investment accounts, we're looking at their insurance, we're looking at their legal, and then we're kind of making an action plan for them to say, hey, these are all the things you need to change. And that looks really different for everybody. So it certainly depends on the phase of life that somebody's in, as far as like why they would need a financial advisor. Finding a good one, it's really tough. Honestly, I think referrals is a good way to do it if you know somebody who's had a really good experience with a financial advisor. But it's like you honestly can't give like a firm name. You can't say go to Edward Jones or go to Raymond James or go to these different companies, because a lot of those they're individual practices, right? And there's not a lot of corporate kind of stability, I guess, across the offices. Every single advisor is going to be very, very different there. And you kind of want that, because, you don't want, a big corporation saying, all right, every single office needs to be invested exactly the same way. Here's like the 10 mutual funds that you can choose from to invest in. And so you don't want that. But then at the same time, it means every single office is a little bit different. So there could be a very good Edward Jones advisor. There could be a really bad Edward Jones advisor. And so you definitely have to do your research. And if you know somebody who, is at those places, that's probably the best way that I've seen. If you just know, hey, this financial advisor is really taking care of me, I want to tell people about them, that's a really good way to do it. But certainly just interviewing the financial advisors too, understanding like what their fee structure is, looking at historical returns on some of the accounts that they manage. If they run what we call models, where they have a certain growth portfolio that they'll invest clients in, saying, all right, how is that done over these different market cycles? So you can actually have some data to kind of back that up. Of course, past returns don't indicate future returns, but it can still give you a good idea of maybe how active they are in managing those funds. So honestly, it's very tough.
Yeah.
Which like to a lot of people, the reason why maybe they delay getting a financial advisor is because it's so tough to like find a good reputable one. And sometimes you get a good one and then maybe they, retire or, leave or whatever it might be. And so then like you're on the hunt again. So that can be a difficult thing. Obviously me being younger, like I'd say a lot of clients like that to some extent because they say, hey, he's still got the experience that we're really looking for, but I know I'm not going to need to find another advisor in retirement. I'm not going to have to like hunt when I'm 75 years old. I know, they can be with me for a long time. So that can be a benefit too.
I'm jumping ahead a little bit because I think that the perception for a lot of people is they have to be wealthy to need a financial advisor. So what stage do you think is the best time other than like as soon as possible? Is there a very specific thing?
I know it's kind of like it's never too early, but it's never too late type of thing to get a financial advisor. I think the services that you need from the financial advisor will be different depending on your stage of life. So as soon as somebody like graduates college and is, in their first kind of big boy, big girl job, can be a really good time to at least talk with a financial advisor. At that point, you might not have any assets for them to manage. Like, I talked about how we're, fee-based. And so we charge a certain fee on the assets that we manage. A lot of times we wouldn't be making any money if somebody doesn't have any assets for us to manage. And so in those situations, we'll just put together a financial plan for them. We'll say, hey, here's like a flat fee. We're going to look into all aspects of your finances and just make a one-time recommendation. And then you're just contributing to your investment accounts from then on out. And that one, it's a little like lighter touch, I guess. Like we're not guiding them through the entire process. We're saying this is exactly what you need to do. But that like one tiny tweak when you're that young, like just changing the trajectory a little bit can have just a massive difference by the time you're 45, 65 years old.
Yeah.
But then when somebody's getting close to retirement, that's another really big time too, where it's like, hey, we're closing in 10 years away from retirement. A lot of times people don't know how much money they actually need to retire. They've heard some rule of thumb where they're like, oh, I need $1 million or I need, 500 grand or whatever it is. And there is no good rule of thumb for how much money you need to retire. It completely depends on how old you are, how many years you're going to live in retirement, how much money you need, how much your Social Security is going to be every single year, whether you're single or whether you're married, what tax bracket you're going to be in. Do you want to leave money to your kids? Like there's so many, like people can retire on, $300,000. Some people need $3 million to retire. And so
Depends on your lifestyle.
Oh yeah. It's a huge, huge factor. And so a lot of times they have some number in their head that they want, but there's not a lot of, true data or thought behind what that number is. And so especially when you're maybe 10 years out from retirement, that's a very good time, if you haven't met with a financial advisor, to get a good pulse check on how close you are to retirement.
Yeah, that makes sense. I mean, I think it's so smart that you have some sort of an offering for people who aren't at a point where they've got a ton of assets yet, but you're still in conversation with them. Because at least from like my perspective of hiring CPAs, right? When we first started, I was hiring just like your typical $1,000 to file my taxes CPA. And as time has gone on, I've graduated to someone who's much more of a financial planner and a tax strategist than just a typical CPA. And it's much more expensive, but holy cow, the value that guy brings is intense.
Right.
But I wish that I could have started with him sooner and that he had like a smaller offer for when I was, a baby investor, to just be like, I don't want to have to jump from relationship to relationship as time goes on. Like I would like to establish one young and you just, work with me when I'm scrappy and still trying to figure it out so that I can have that relationship long-term as opposed to like trying to find a new one 15 years down the road.
Right, exactly. I know, and a lot of the people who are younger, like they're just focused on other things. They're not necessarily
not in the front of our mind at all. I didn't even think about it until I got pregnant, honestly.
Right. Yeah. And it's a tough thing because a lot of financial advisors don't necessarily have the timeline to say, oh, I'm going to invest in this kid for 30 years, and then the payoff's going to be down the road. So with us, we try to do that a lot of times with our clients' kids, where we'll say, hey, if you have a kid or a family member, whoever, let's just hop on a call with them. We're happy to answer any questions that they have. Let's just do a 20-minute phone call, introduce ourselves. Like if I can give them one little nugget of advice that just changes the trajectory a little bit, it can just make a huge difference. And one of the big ones we see is that when people start working, a lot of times they're defaulted into like a 401k. And usually that 401k is a match. And so the company will say, all right, if you contribute, 5% to this account, we'll match 4% or whatever it might be. And so almost always I see people, their default is, all right, well, let me get the match because I've heard that's what I'm supposed to do. So I'll contribute 5% to this account. I'll get the match. But most of the time that's not a sufficient amount to save for retirement. So even if I can tell them, hey, 15% is a good amount to save, between your contributions and the company match. So in that scenario, you contribute 11, they match 4. That's a good baseline to start out with. And again, that's just a rule of thumb. So that might need to be tweaked later on. But at least if we can start with that being the default, that's gonna make a big difference down the road. Because there's just so many people that, live based on, all right, what's the paycheck coming in? All right, if I've already saved a little bit, even if it's that 5%, I know I can live off the rest of this. And a much better way to kind of do it is say like, hey, let's solve first for the amount that we actually need to save, and then the rest we can live on.
Yeah, I feel like that's so needed because I remember when I got a job at the hospital, it was like my first big girl job, and they give you all the paperwork and they just slam this packet down and it's like, this is the retirement packet, go ahead and read it and decide how much you want to put towards it. And I was like, that's big, and I'm in college and I don't care about it. So
small text, a lot of pages.
I was like, I don't understand any of that. And they had like a match program and everything, and I don't even know what I did.
Right.
I don't know what decision I made on that.
It's so much all at once. Or like, how much life insurance do you want through work? Do you want to be on the HSA plan? How much do you contribute to the 401k? Fill out your W-4. Like, how much do you want withheld for taxes?
And you get your paycheck and you see all the amounts that came out, and you're like, dang.
I don't want to invest anymore.
You're not looking in the future. You're just looking at the right now.
Right.
Yeah, I want to go on spring break. I don't want to invest
Literally.
this 15%.
Yeah, exactly.
So, I mean, from your perspective, because obviously we host a lot of real estate investors on this podcast, typically not traditional investment people. And so from your perspective, we own property together. You're investing in both, right?
Yeah.
What would your advice be for people who are listening to this on how to balance, do I take this money and do I put it into a short-term rental, or do I put it into a piece of real estate, or do I put it into the stock market? Like, how do you decide or give advice on how to figure out that balance?
Yeah, I mean, one of the things we talk about a lot is just diversification. So, I mean, there can be a benefit to going really deep in something, getting to know an industry really well. But from your personal investments, I think there's a lot of value to diversification. There's a lot of folks who do wonderful in real estate, or have done really wonderful in real estate, and then 07, 08, wiped them out. And so that's a risk that you have. And I mean, it's similar. It's with anything, with Bitcoin. It's like if you would have invested 100% of your net worth in Bitcoin 20 years ago, you would have done great. Yeah, I mean, it's high risk, high reward, right? And so you just have that risk, because if you have the vast majority of your assets in one particular asset class, if anything kind of structural or institutional were to happen to that asset class, then it can be difficult. Legislation risk could be a big thing with Airbnb. I mean, as we've seen, a state can just be like, all right, you're not allowed to do Airbnb.
Yeah.
And so that's a big risk that you have, specifically with the short-term rentals. So I'm a big fan of the diversification. From a return perspective, the Airbnb has significantly probably outperformed what the stock market has done, but it comes with more, upfront cost. It comes with more time and energy put into it. I was like doing a calculation the other day. The internal rate of return for our Airbnb property, which let's say we put in, I don't know, $150,000 in total. It's maybe cash flow net of all expenses and everything like that. I don't know, let's say $40,000 a year. If we were to sell it today, net of the loan, we'd probably get $200,000 or something like that. That internal rate of return would probably be about 27% when I was looking at it. That's an amazing return, right? I mean, that's a wonderful way to build wealth. But as you start to build wealth, one of the things that investors could do is take some of the income that's being generated from the properties and start to diversify it elsewhere. Where we have the real estate taken care of. Let's get some money in the stock market, just so we have a balanced portfolio there.
Yeah.
Yeah, because you look at that 27% and how much work did it take you, where versus like you just put the money in the stock market and sure it's lower, but you're like, I didn't do anything.
Right. Yeah.
Yeah.
Yeah. Maybe that leaves you more time to like, create more income elsewhere at your job or whatever it might be. So it completely depends. And ours being short-term rentals has a much higher ROI too, especially with interest rates where they're at right now. There's a lot of people, if they're doing long-term rentals, I mean, they're like breaking even on their mortgage versus what they're bringing in rent, and it's still not passive. So they're still having to deal with the tenants and deal with evictions and maintenance and all that kind of stuff. So long-term rentals right now I'd say are pretty difficult. If interest rates go down, it could be a little bit more lucrative. But
Yeah. Well, that makes a lot of sense. We should just take all of our money from Hale and throw it in the stock market. But every time I see a house, I'm like, or we can buy another property.
It's much more fun. I mean, the houses are more fun to look at,
I feel
right?
like once you diversify to a certain point, though, you get to like have a little bit more fun with your investment, right? You're like, I get to be creative with that. I feel like I'm taken care of over here. So like, let's go have a little bit of fun and still make money on it.
Yeah.
And then your goal isn't necessarily the highest ROI. It's let's just enjoy what we're doing. And that's one of the things that I tell to a lot of my clients who are on the higher net worth spectrum is that you can afford to be as conservative or as aggressive as you want to be when you've kind of met a certain threshold. Because, if you have $4 or $5 million, I mean, we can, and you're living off of, $100,000 a year, Social Security is taking care of part of that. I mean, we can set aside, a smaller portion of your wealth, and then the rest of it, we could be, relatively growth oriented, relatively aggressive with it. Because if it were to go down 40%, we've already got everything that you need kind of set aside over here. Or at the same time, you could be as conservative as you want because you don't necessarily need the money to grow super fast. You've already kind of taken care of everything that you need for the rest of your life. And so if you only want to grow 4.5% a year or something like that, you can certainly do that. And you can be off the roller coaster. And so, I can kind of present that to clients in that situation. And a lot of times we end up with more of like a moderate approach where they're like, hey, I do want to see my assets grow, but I don't want to be on the roller coaster and see a huge, drop if the market were to go down. And so we can take a more middle of the ground, way of going about it. But it gives you the opportunity to at least have some fun with it if you want.
Yeah, that makes sense. I think honestly, one of the most interesting points you made so far as well is just your age and how that makes a big impact on being able to like maintain a relationship with someone because you're gonna outlive them.
Right.
Right. Like the other day, very recently, I guess Thanksgiving of last year, we're having a conversation with our dad who has a different financial advisor or had. And like come to find out he's passed away, or whatever. And dad didn't have any idea. And it was one of those things where we were like, oh, like you get to the end, and our parents are now retiring or recently retired. And you're like, oh, the guy that's been managing my money forever isn't even like now when I need him the most. Right. And I've built this trust over time. Like now I have to go find a new one.
Yeah. Yeah, exactly. Yeah. And that's a scary thing to do in retirement. Most people don't want to be interviewing financial advisors and trying to identify who's going to be the best one. And I mean, if you've been with the advisor for a long time, you've seen them through kind of different stages. That advisor can help you through the accumulation phase, through the preservation stage, eventually through kind of the distribution stage of your assets. And that they're well-rounded there. If you just go, find somebody in retirement, maybe that advisor is really good at like growing the assets, but maybe they're not as good as kind of at that distribution phase where clients are more so interested of, all right, how do I, leave money to kids? How do I, donate in a way that saves me the most on taxes and, preserve some of my assets there too. So, I mean, you got to find somebody who's good at all this.
That would be you.
I have a selfish question, and it doesn't apply to Sarah right now. We are both parents. So how do you see investing for your child now? Like, are you planning that already at the age that she's at? Because I constantly have people telling me like, oh, you need to like start a custodial account for your son and you need to add money to it and you need to do this. So like, how are you thinking about that from her perspective?
Yeah, I'd say one of the most common ways that we do that for clients and one of the ways that I do it personally is through a 529 account. And that's like an education savings account for a child. So or you can even do it for yourself too. But it's a tax advantaged account to save for education expenses specifically. Indiana has one of the most tax advantaged programs for these 529 accounts. And basically you get a 20% state tax credit when you contribute to the account, up to like a $7,500 contribution. So if I put in $7,500 a year into this 529 account, I get a $1,500 state tax credit back on my taxes at the end of the year. So like if I had owed in $1,500 prior to making that contribution, I would owe in nothing after that. So a credit's much better than a deduction. Deduction's just kind of reducing your tax liability. I think in Michigan, you just get a deduction for the amount that you put in. But that's probably the most common way we see people save for their kids. Parents sometimes they feel more of a responsibility to help with the education costs, I'd say. As far as like helping kids save for retirement, I don't see too many parents feel a like necessity to help them with that. A lot of times the parents are like, hey, I didn't really get anything from my parents. You know, I had to like start from zero. Yeah. There's a lot of parents that have that mentality. Also, a lot of the times, like with my clients, even if they have that mentality, there's still a decent amount that gets left to the kids just because like to have a kind of fully funded financial plan, we want some money left over at the end. We don't want to be like having the check for your casket bounce, you know, when you're writing, like we're not trying to cut it that close.
Check for the casket bounces, throw them and burn them.
Yeah, exactly.
Bonfire to celebrate.
Dad was fine with cremation, right?
DIY.
Yeah. So, I mean, I think the 529 accounts is just the most common one that we see. The custodial accounts, sometimes people save in those as well. And that can be a good way to do it. They're not as tax advantaged, but they also don't have some of the strings tied to them where like the 529 needs to be used for education. The custodial account can be used for anything, and the kid gets full control of it either at 18 or 21, depending on what state you're in. And so sometimes parents don't even like that. They want to have more control over that custodial account and say, you know, hey, at 21, if my kid wants to go blow this, I don't want them to have the ability to do that. And so sometimes parents just like retain control of the assets. And a lot of times parents are passing away around the time that their kids might be retiring. And so they just say, all right, I'm just going to pass down assets at death. And that's
the retirement plan for them.
Right. Yeah.
That makes sense. Yeah. Cause like the custodial account, honestly, our CPA recommended that I get it for Oz. And like, I can pay him a certain amount every year that comes out of my business account because he's like on the marketing and stuff like that.
Yeah.
And so then we can do that. But then like his life insurance policy, he can borrow against it at a certain age. And so I'm like thinking of it from all different aspects to where I don't even think I have that stuff set up for myself, but like I'm setting it up for him, you know?
Yeah. Which can be a really good thing to do. So yeah, that specifically with paying your kid, that is kind of a nice thing that is allowed if they're in the marketing. You can pay them a certain dollar amount every single year. And I think you get to deduct it.
And there's like a certain amount that's tax free, and then above a certain amount, they like tax only the amount above that amount.
Yeah, and I guess one of the things in the new legislation that Trump just signed too is what he's calling Trump accounts. So this is going to be a new thing.
Here we go.
Yeah,
his ego needed that.
Right. I'm sure 401k sounded really weird when that first came out too. So maybe we'll get used to it, but. So I think any kid born between 2025 and 2028, the federal government will put $1,000 into the Trump account, and it's somewhat of a tax advantaged account. I haven't read the different rules, or I don't even know if they've come out with the rules on how it's going to be tax advantaged. Might act similar to an IRA or something like that, or a 529 account. But that's going to be another way that parents could save for kids too.
I'd be very interested to see after 2028. Does whoever else comes into office just like take it away?
Right.
You know, like what happens?
And is it a one-time deposit of $1,000?
One-time deposit of $1,000.
And is it
not like annual
rolled into like an investment, or is it just sitting there and like the parents can contribute? All questions that I have about this.
Parents can contribute to the account. I think it's set up to like $5,000 a year or something like that. After 2028, I think that legislation is set to sunset. So it would take new legislation being passed for that to continue on. Same with actually a lot of things in that new bill have a sunset built into them, the new state and local tax deductions and things like that. that kind of what they're calling senior bonus, which was Trump's thing to like try to reduce taxation on Social Security. Doesn't actually change taxation on Social Security, but it gives people over 65 like an extra deduction on their taxes. That's set to stop in a few years too. So a lot of those things have built-in provisions just to end when Trump's out of term. So I mean, he can at least say like, "Hey, I promised this. I was able to deliver it for a couple years."
Yeah. Now you get to hate
hope
the next
that the
guy.
next person who's in office keeps it going. But
Yeah.
Right.
Yeah. But there's no sunset situation on bonus depreciation now, correct? Like
I actually don't know. Yeah, I haven't
I
looked
think he made it permanent.
Okay.
We were just on a call with our CPA, and our CPA was talking to the investor that we were on the call with, and he's like, "Yeah, it's here to stay. It's permanent now."
Oh, that's good. Yeah,
was
yeah. It's like a
like,
900-page bill or something. So we're still combing through it.
Yeah.
But,
Yeah. One question I've got before we shift into kind of a different topic is, we deal with, like, right now we have a client in Newaygo whose dad made a ton of money. Dad passed away. Mom has the money now. And they are, as the kids, they're beginning to invest this money in real estate or in their own ventures before the mom has passed. Right. And the mom is essentially being like, "Look, this is your inheritance anyway. There's no reason for us to wait until I pass for you guys to have access to this money." When you're dealing with your clients and you're looking at their kids, is that something that you advise often if they are going to be leaving an inheritance? Is like, can your kids put this to use now? Or is that like if you want to make them wait, make them wait?
right. Yeah, that's an idea I float to a lot of clients. At the end of the day, like I have a fiduciary responsibility to the clients themselves. So we need to make sure that they are personally taken care of in retirement first. But there are a lot of situations where they have plenty, like they're perfectly fine. Maybe they even have like a pension, plus Social Security. They're completely taken care of from a cash flow perspective, and the assets that they have, they're already planning on leaving to the kids. That's when we start to have that conversation of, do we want to accelerate this a little bit, or depending on the size of the estate, I mean, sometimes you could be worried about estate tax in the future too. And so we actually start gifting ahead of time just to avoid taxes in general. But that's a pretty high threshold still. But yeah, a lot of times we do that with the kids, where either we give them some money ahead of time, or we just start having the parents do fun things with the kids, where we say, "All right, once a year, you take $15,000, take the entire family, get an Airbnb, you cover all the expenses, just have them get there." And we just have good conversations about how we actually want the kids to use the funds. And at the end of the day, it's just up to the client. There are some clients that don't want to do that. They say, "Nope, if the kids get a little something at the end, or even if they get a lot at the end, I want them to just have it when I'm gone." Most of the clients are pretty open if they know that there's going to be money left over, that they want the kids to enjoy it while they're living. So then they can kind of see the kids enjoy it, like they can have fun with the assets ahead of time.
I feel like the idea of waiting is like their ego wanting them to like get a big check, They're like,
Maybe.
"Here you go."
Yeah.
And that
By
like
the
makes
way.
them feel good, knowing that like they'll be sad when they're gone, but this thing is going to make them feel better. I feel like
Right.
that's how I would think about it.
Yeah. Yeah, I know. I tell our parents all the time, I'm like, spend it. Spend
Right,
it,
yeah.
like quit being like, "Oh, we've paid attention to our finances our entire life, so there's something left over." I'm like, "No, let's blow it now." Like,
Tyler's
Let's have
family is
fun.
kind of like that. Like every year we do something and his dad's like, "I want to like enjoy all of this with
Yeah.
everybody too." And so he's like, "You'll get stuff at the end, but like, let's all do fun stuff
Yeah.
now." And like every Christmas he does a game where everybody gets a little money because it's just
Yeah.
like a fun thing for him to experience.
yes,
Right.
yes. And I want the memories with our parents now.
Yeah.
Like, I don't want we'll figure out how to make money when our parents are gone, right? We're figuring that out now. But like with their money, I'm like, if you're just going to hand it to me, or we can spend it together, I'd prefer to spend it together.
Right. Yeah. I know, but it's like, you notice when clients amass, that amount of money, and they know that they're already taken care of. A lot of times it's not even that attractive to spend it. They've just gotten so used to a certain lifestyle, and you do really, like, it sounds so cliche, but you do realize, like, money can't buy happiness. Like I love, the lifestyle that I have. Spending more money would not increase, it would increase my cost of living. It wouldn't increase my standard of living, I guess.
Yeah.
Or the
Level of
happiness that I'm
joy.
getting. Right.
Yeah.
Yeah. And so I have plenty of clients where it's like, "Hey, do you want to leave money to kids?" And they're like, "Not really." And I'm like, "Okay, well, we got, a couple $1 million saved up. Do you want to spend more?" And they're like, "No, not really." It's like, okay, well, we're probably going to leave money to kids then, because that's where it's going. But That's always a better conversation to have than the one where it's like, hey, we're spending a little too much. We need to dial it back. But there's a lot of people in that situation where they know they can spend more and they're just like, I don't really need to. I realize like that hasn't really increased my happiness at all.
Yeah. Have you found in like that transition of having conversations with people's kids where you've managed the parents' money for X amount of time and now maybe they've passed away or whatever that looks like and now you're dealing with the kids, do they have the same level of interest in financial planning that the parents did, or is our generation or the generation below your typical people that you're servicing more or less interested in it? Like, are they blowing it or are they continuing the legacy and growing it?
Yeah, that's a good question. I'm trying to think of a few examples. Certainly, I would say when they're younger, it definitely depends on the income level. I've noticed folks with like, when they're younger with really high incomes, they're much more prone to blowing it because they're like, I've already kind of gotten it taken care of. I'm 30, I'm making $300,000 a year, whatever it is. And they're like, I've kind of already got the money thing taken care of. I can almost afford to be a little irresponsible with it
That's
now.
how I feel.
Yeah, right.
That's the definition of how I feel.
And like, if I'm working with their parents, like I never share information between the clients, even parents and children, unless we do like a joint meeting and they want to be open with their finances. But a lot of times the parents have shared with their kids, maybe they have some assets that are going to be passed to them. So then they kind of know, okay, maybe that's already taken care of. Maybe I don't know the exact amount that I need, but again, I can afford to be a little bit more frivolous with my spending right now. Which is always just a dangerous thing because you never know what's going to happen. There's a lot of unknowns between now and retirement.
Is that hard for you when you like know that money is coming from the parents to like guide the child in investing when you're like, I know that you're going to be getting this, so like go spend it? Like, how do you manage those conversations?
You'll probably be fine, maybe.
Yeah.
Wink, wink.
They're like, can I withdraw 12% a year? And I'm like, yeah, you should be good. Like, no, yeah. I mean, usually in those situations, then I'll talk with the parents and say, hey, do we want to have more of an open conversation with the kids? Like, do you want the kids to know about this? And sometimes the parents are like, no, I don't. And so then if that's the case, then we act like the kid is not getting anything with inheritance. And I don't even know if I've ever had it where the kid asks, am I going to get an inheritance? And if they did, I'd say, I can't say. Like you'd have to chat with your parents about it. Most of the time, a lot of people, even if they know that they're getting an inheritance, they like to act as if it's not there.
Yeah.
And so like maybe I don't even have the parents as like a client, but I have, a 65-year-old client. They're, really getting close to retirement. They have a 85-year-old parent or 90-year-old parent. They know that money is coming. Even in that situation, a lot of times they're like, I want to make sure my plan kind of stands on its own 2 feet. And then anything that comes on top is just gravy, and it makes the plan look a little bit better. So I'll build that into the financial plan and just, say expected inheritance, X amount, but we'll only build it in as like $1, so that we're not leaning on it, but we kind of know it's there in the back of our heads.
Yeah. Yeah,
a little bit of a family therapist, I think.
As he is for our family as well.
Yeah.
there's a
I'm
lot
like,
of.
are we good? Am I good? Help.
The whole like behavioral finance side of things is such a massive part of it, and that's where it can be difficult again to find a financial advisor because you're like, I need somebody who can like talk me through these things. I had a client just at the beginning of this year when all the tariff talk was going around, markets dropped. She called and was like, literally used the phrase, I need you to talk me off the ledge right now. I need some help here. And so great. We just talk through it. You instill some confidence. You talk about what moves you've made in the accounts to help avoid some of the losses. Talk about if you kind of like anticipate a recovery, why we would possibly anticipate that. Talk about, hey, you're taking X amount a year. We've already set aside 3 years worth of withdrawals and conservative assets for you. You're going to be okay. And then they just relax. And that's one of the big helpful things of having a financial advisor is honestly just if you can avoid a big mistake when it comes to your finances, even one, it can make a massive difference. There's a lot of clients in Indiana. There's like a few big companies there. There's, Raytheon is a big company. Eli Lilly is a big company in Indiana. There's Steel Dynamics. There's Nucor. There's some of these big companies where folks have just worked blue collar jobs their entire life, but they've built up, 800 grand, $1 million worth of like Eli Lilly stock or something, and just deciding what to do with that. There are people who sell all of it, when they hit a certain point and go pay off their house that has a 2.5%, mortgage interest rate, and they just sold $800,000 of Eli Lilly stock. And you're like, ooh, like they come to us after that decision and they're like, hey, was that good? And you're like, I don't know if I would have done that.
Very bad.
Yeah, we like the stock. You're paying off a 2.5% mortgage. We probably would have done something different. And so even having a financial advisor just to bounce an idea off of and maybe avoid some of those bigger mistakes can be a big benefit.
Yeah, that makes a ton of sense. Well, Caleb, I think we're at time here, right?
I have one last question.
Yeah,
because you mentioned at the beginning that you guys are open about talking with money. And I even remember, and correct me if I'm wrong, but I feel like I remember growing up, like listening to your dad talk about like, okay, we've budgeted for this many vacations a year. We have the timeshare. Like you guys have always been open about talking about money. Do you feel like that makes your conversations easier? And do you like really recommend parents talking about money with their kids? Because until I became an adult, my parents didn't. They're very open about it now, but they didn't. And so like money to me, I've always been like a hold on to it person. Don't do anything with it. And I think that does affect the way that people see money and like investing.
Yeah, that's
Love
a great
that
question.
question.
Yeah. I'm very pro being like open with finances within the family, and it doesn't even you don't even have to actually open up the apps and show all the money that you have, but just being open about, hey, this is what we did, this is what we wish we would have done, this is how we budget our monthly finances, this is what we'd recommend to you. I mean, it just gives the child at least one point of contact or like one point of reference for what to do, because so many kids are going into it completely blind. Yeah. They're like, I have no clue. I saw like a video on TikTok of how to budget like for my monthly expenses. Here's a random rule of thumb to try to follow. And that certainly does not carry the same weight. And I think a big thing is when parents admit maybe what they regret or what they did wrong, where they're like, look, we did not plan for retirement until we were probably 40. Don't do that. Like change the trajectory, be different than what we did. Like we'd recommend doing this now. That just carries so much more weight for the kids because they've grown up with the pros and cons of that. Our parents did a very good job of like, setting stuff aside and being open with us about that. And so, we could see the positive benefits from that. Other folks have seen the other side, and that can carry probably even more weight on the other side where they're like, hey, I want to be a little bit different. I saw my parents being worried about paying the bills at the end of the month or whatever it is. How can I set myself up now to change that? And especially it just a lot of times ends up being starting earlier is one of the biggest things. So like the amount of money that you save for retirement from probably age 25 to 35 is going to have a bigger impact than what you save from 35 to 65, just because that money has more time to compound in the market, even though you're making a lot less. So starting early, taking some of those like positive and kind of negative things that your parents have done can carry a huge impact for kids.
Yeah, my parents were much more open after 2008 when they had to file bankruptcy. Like they talk about having to completely restart, and now they're comfortable. And like my dad just retired and they're good. They've gone to see their financial advisor, but they talk about how they had to like scrape to get to good after having to restart in 2008. So they're much more open about it now. But before then, I think like the thought of losing it and then actually losing it, they were like, oh, we need to like think about this a little bit better.
Yeah. Well, and I always talk about every chance I get how much of a positive impact it made having dad specifically sit me down, and I'm sure he did the same for you when it came to going to college. And like going to college, I just remember being like, okay, I want to go to the nicest school because that's prestigious and I want to do well, right? It like comes from a good place. It comes from a place of ambition. But I was trying to decide between two different art colleges, and one art college was twice as much as the other art college. And I got a scholarship that was like 4x the size for the one that was twice as expensive. And so in my brain at that point in time, I was like, oh, if this scholarship is 4x the size, like this is going to be the college that I go to, like I've got a bigger scholarship. It's a nicer school, whatever. And dad sat me down and was like, this is what your debt will look like at the end at the more expensive school, even with the larger scholarship. And this is what your debt will look like at the end of the less expensive college with a lower scholarship. And like now I look back on that and I'm like, I can't imagine if I would have made a different choice,
right?
And really almost no one that I know that's our age had that conversation with their parents about how much they were going to end up in debt after college. And most everyone that I know that's our age has a ton of student loan debt. And I just remember that conversation so vividly, being like annoyed that I couldn't go to the more prestigious school. But now looking back at like the risks that I can take because I don't have that, I'm like, every parent needs to have that conversation, you know?
Right.
So it was just such an open topic. And it still is. Like every single time our family's together, we're like talking about finances in some way, shape, or form, which
I know expecting like a 17-year-old to make that decision that's a lot to do.
Yeah. My parents' advice was going to the military because they didn't go to school. So they were like, enlist. And I was like, no.
Which was great advice at that point, you know, that, like it works for them.
That's just what they knew, you know?
Yeah.
Right. Yeah. Yeah, exactly.
Yeah. Well, Caleb, it has been an absolute pleasure. For our listeners, if they are looking for a financial advisor, one question that we didn't get answered on this is, even though you work in Indiana, can you service anyone in the U.S.? Like it's not a license that's specific to Indiana. That means that you can't help people in Michigan.
Right. No, I've clients all over the United States. So we got people in California, Michigan, Florida, Minnesota. We got people everywhere. So
how do they reach you? Like, how do they get connected with you if they want some advice from you?
Yeah. So, I mean, our website is it's called fosterfinancial.net. And then, you know, like calling the office too. I think our number is 260-234-2200. So,
oh, you was on there.
Yeah, we got
I
it
barely
down.
know my own phone number.
right. So yeah, we typically just start people off. You know, we get an intake, kind of see where they're at right now, what sort of advice would be useful to them, and then we either do a video call or have them in person to chat about things and see where we could potentially help them.
Beautiful. Well, thank you so much for coming on. I think it's so refreshing to get a kind of more holistic perspective on investing as opposed to kind of the silo that we have of just talking short-term rentals all day, every day. And I know it's a common kind of behind closed doors conversation that we have with our mentees and, people who are just really trying to have a better, more financially secure life than their parents, know? So if you're listening to this and you're looking for a highly recommended financial advisor, I would literally trust you with every dollar that I made. So if you're looking for someone who comes with a high recommendation from us, it's definitely Caleb. But reach out to him, see if you can connect with him. And if you're looking for a financial advisor, go ahead. He's open book. So.
Yeah. Thanks very much. This was great.
Yeah. And for our listeners, we'll see you next time.
Bye.
All right. Bye.